So back with Doug, myth number 7, investors are only interested in companies that are already profitable.
Yeah, no, that's definitely not the case. The investors, once you're already profitable, the extent to which they can add value and ask for an ownership share goes down, right? So if they're investing pre-profit stage, in fact, even pre-revenue stage, then perhaps there's way more value added that they can bring to the organization, help the organization out in terms of the things like the structure, governance, putting into place stock options for employees, help build the right team, provide a set of networks, legal contacts, investment contacts, the right accountants, the lawyers, everything to build the right team to help it get together. All that can be done, and the investor can add a lot more value the earlier the stage that they're at. And so a profitable business that's already, maybe that's, could be for a private equity type deal at a much later stage. But for the venture capital, typically they're going to be looking for pre-revenue businesses, or at least pre-profit businesses, when you're in the valley of death, so to speak, where you have, maybe some money coming in, but a lot more expenses. And that's where an investor can really help things and get it to the finish line.
Thanks, Doug. And this is where there's basically a contradiction between growth versus profitability. And we have seen more recently a bit of a shift in more conservative times, where VC and PE firms have looked more towards profitability or sales, not just proof of concept, but they've almost applied criteria for later stages to their earlier stage investments. And then the problem you end up with potentially is if you look for profitability versus growth, and they do tend to run a little bit counter, particularly the earlier stage you go, then you won't get the return that venture firms need to get. So often you see entrepreneurs burning cash so incredibly quickly to grow so incredibly aggressively. There's again another quote from Josh Lerner, which he said to me about our own business, which is you have to raise money and grow aggressively to crush any emulators. That was the terms used, to crush any emulators. In other words, grow aggressively, grow rapidly, as opposed to grow in a sort of more steady state, business as normal kind of approach. Venture and private equity are meant to be about growth. Private equity more about maybe cost stripping and maybe increasing profitability, but no venture or private equity firm can get a return if it's just a steady state, business as normal kind of approach.
Yeah, very true. And that's going to vary a lot by industry and how replicable your product is. So those incentives are going to change a little bit, industry context, the extent to which competitors can come in and steal your thunder, so to speak. So you need to be very careful about your goals there, subject to the industry that you're in.
And some industries like biotech are not expected to make any money initially, because it takes many years to get there. So venture capitalists and those kind of industries understand that there will be no revenue, let alone profitability in many cases there. And the exit they get, the way they realize their own returns might be by selling the business, as opposed to from the old-fashioned EBIT, the old earnings spitting out, paying dividends.
Exactly, yeah.
Thanks so much.
Thank you.